Well, hello, everybody, and welcome to the Middle Class Investor. Thank you for coming in this week. It's good to have you in here for another week of talk of markets and technical analysis and a little bit of Elliott wave sprinkled in here and there. Well, we had another up week, second one in a row here of the last 2 weeks. And pretty significant move here. Pretty significant. Last week was right here. Week before last was right here. Now we're still operating under the forecast that this is an A B C. So A B C with this whole thing being C, and this right here being a wave 4 triangle right here. And C, so A, B, all this is C. So it's been a very deep counter trend move, especially if we're operating, if our forecast is that this is a 1 2 1 2, very deep retracement. I think we're now more than 78% retracement of this move right here. And obviously the odds now wave 2, if this is a 1 and we have another wave 2 here, it can retrace up to 100% of the previous move down, and it still can be a wave 2. Now, having said that, once we get above the 78%, I don't see too many going all the way back. So there's no doubt that if this continues to move up, the odds of this being counter trend, we might have to change what we're thinking about there. So, but it still looks pretty counter trendish. And one of the things I want to point out is that the 200-day moving average is right here. So, very often in a bear market, the 200-day moving average will fall, and it's just barely fallen here. You can see it's almost just flat, and then it kind of fell here, and then it's gone flat again. But very often what will happen is the 200-day moving average will start to roll over like so, and the market will obviously chop, but it will make periodic visits back to the 200-day moving average as it falls like that. So it just so happens that this, with the 200-day moving average is pretty high, and the market accelerated pretty rapidly here. So, we don't have the same kind of, we've got kind of a two-stage topping process. We have, this first one here, and then another one here, and then potentially another one could happen here. So markets top in different ways all the time, and it never does it the same way twice. In fact, I hear that on TV a lot. The housing market is much more, much more secure now, and blah blah blah, and all this. What's interesting is Fannie and Freddie are trying to go back public again. The government bought them, and here we are, right? Now that they're out of the woods, right, they want to go back to making big bonuses and stuff. So I thought that was kind of interesting. And the timing of it is interesting, too, because it could actually cause the government to step back in again and take over Fannie and Freddie. But those are just some interesting anomalies. Those aren't necessarily causal. We talk about here, we use this Elliott wave model because it really gives us a good feel for when you can really expect the market to, change direction. And there's other tools you can use in conjunction with Elliott that do that, like the commitment of traders data, trend data. Trend is a service. It's kind of like a bullish percent or bearish percent type of. I can't think of the word. There's the sentiment indicators. So, but anyway, right now we've had a couple strong weeks. We've got this thrust out of this triangle that kind of happened in here. So, usually a triangle marks the final move. Once you've had a move out of the triangle, it usually marks the final move of that particular trend. So if we look at a 6 month, for example, which would be an hourly chart, which is not enough. Let's go down. Let's look at a 10-minute chart, and you should be able to see. Man, that's too much. I didn't prepare. I should have prepared for this, but anyway, well, I'm not going to do that. Let me change direction there and say that I'm not going to do that. But I was going to show you this triangle, and the problem is I'm not sure exactly where it is in the trend, and I don't want to spend a bunch of time trying to locate it. But I do have a 5-year chart up, but I did put a daily up because I wanted to talk about that 200-day moving average and its significance. One of the things I want to look at is that we haven't looked at before is high yield, because you may have been hearing about the bond market and specifically the high yield market. And after just a devastating crash of the high yield market, you've had this really strong push up. And it could be that this is going to make a new high. I mean, it's very, very close to a new high. But if it does, what do we know? We know it will go to the previous pivot. So let me show you that. Here's the swing high, and then the swing down. Right. So this area right here is an important high. So this is where we would draw, our little rectangle decision box. So, we look for high yield to make a decision in this area, probably over the next couple of weeks. And this move right here did a lot of damage to the bond market. And so expecting once it tops, and maybe it tops here, maybe it doesn't go all the way up to make a new high. It could start rolling over right here, in which case this would be counter trend. But either way, if we get, let's just say this is the second move. So this is the first move down, this second move. The next move could be very devastating to the bond market, which could cause a lot of angst in the equity markets. All right, since we're talking about bonds, let's look at the 13-week Treasury. This is the one we use to tell us what the Fed might likely be doing. And as you can see, we're still in this range, kind of pushing down from the middle part of the range. But what we're looking for is a breakout of either the low end or the high end. My expectation is that we're going to have a breakout to the high end. So, and that will the Fed will be picking up on that right away and looking to raise rates, even though most people think that the Fed is done raising rates. All right, let's look at the 10-year. If it'll load. The 10-year, as you know, and as I've mentioned many times here before, is the most important interest rate in our economy. It's what your mortgages are based on, and car loans and things like that. So we came down. 10-year came right down into this box that we had drawn off of this pivot right here. The reason this pivot was important is because it was a swing into this previous high. Now this pivot is also important because it made a new high, but I think we'd broken through that one already, and so I drew a new one. And that's just the way it is. Sometimes you draw something on the chart, and the market doesn't respect it, and you have to kind of regroup and draw a new area that you feel like is support. So that's what we did. So if you look at this, let's just look at this real quick because I think it's significant. It'll be, depending on what happens next week, it can be very significant. So we've got a low here. So here's a low, and then the market rallied to a high. Okay. and then we pull back to a lower low. Okay, this is what you want to. This is how you find opportunities. You wait for these long pullbacks into this kind of a support area, and then you look for this lower low situation. Now, if next week we get a close above, so if next week closes above this high, then the probability is, now listen to me very carefully, the probability is that this downtrend move has stopped for the time being. That doesn't mean that the market couldn't rally to here and then roll over and make another low, a lower, maybe lower than this low, but higher than this low. So, in other words, this doesn't guarantee you that it's going to make money all the way up. What you got to look for, what you got to look for is after this pivot, what happens there? What happens at this zone? If it turns and starts heading down, well, then you're likely to be wrong, and so you step aside, because if it rolls up to here and then rolls down, probably somewhere in here you can probably say you're wrong. And yeah, you didn't make a lot, but you didn't lose a lot either. In fact, you didn't. If you do this right, you don't lose anything. You're in here and you're out here, so you have a small gain. Now, what else could it do? It could just let's draw that box back in here. Whoops, wrong thing. So what else could it do? It could pull up into this area, okay, and then kind of chop around in here, okay. In which case, you want to hold that position because that's usually a trend continuation pattern. So you enter here, you run up to here, it chops around a little bit. Maybe even it could chop around and maybe fall back a little bit, but then at some point it'll probably take out and start moving up. So this whole methodology here, looking for a low into support, waiting for that first move, and then pulling back to a lower low. This is a great way to manage something like a 401k, because you can likely what will happen is if it does, let's say you buy here and it comes back and then starts to pull back, that'll take long enough in your 401k that you can make a change. Okay. In other words, you can be wrong and get out and not lose a lot of money in your 401k. But it's a more aggressive. You're not waiting for the trend to establish itself. The problem with that whole trend establishing itself, I mean, let's look at this, for example. Let's look at this right in here, this move right here. So if I'm waiting for this pullback right here, and I got a low here, and then I got a lower low here, and then a higher low here, and a higher low here. Somewhere along in here, I've got to say, okay, I'm going to go ahead and enter. So let's just say it's here. Let's say we enter right here on this breakout of this flag here. That's great. You're making money, and then all of a sudden it's pulling back for several weeks or something, and then you're making money. So you just have to have some sort of, do you get out right here? Do you get out right here? Do you get out at all? So I think, I don't know if I'm making my point clear or not, but you want to try to identify this yellow region here on your chart and use it in conjunction with your strategy. So here we had this blue region here, and it pulled back into it, and you can see we got a good run out of it. And so that was a run up, a pullback. It didn't quite get down into this yellow area. We were talking about it maybe reaching the gap. Never did reach the gap. The gap's still open, and then it took off. So, but I think it's important to try to put these little boxes on and wait, be patient, and wait for a pull back into that area, and then wait for your higher low and a break above that higher low to enter. Okay, so we'll know something next week a little bit better about that. But I thought that was an interesting thing to bring up this week. All right, let's look at some of these other countries. Germany, as I mentioned before, I think the bear market, when it arrives officially, is going to be a worldwide event. Talked about Peter Schiff, who I think is brilliant, and I think he's right about the dollar. The dollar ultimately will collapse because the government's not going to do the right thing, and they're just going to print more money. So that will lead to an eventual collapse of the dollar. But I think he's way early. Maybe he might be as early as 10 or 15 years early. I just think my experience in waiting for this bear market is it's all taking a lot longer than you might think. So, I first started talking about this like 3 years ago, something like that, 3.5 years ago. And it's amazing how long it's taken even to get to here. So I think Peter is probably ultimately going to be right about the dollar. I think he's just way early. So here's Japan. Japan looks pretty soft. The United Kingdom looks about the same. Again, I think this is going to be a worldwide kind of a topping process, and I think there's not going to be any place to really hide. Cash initially is going to be a great place to hide, and there'll be times when the market. In fact, let's just go look at the market. There'll be times after the market makes a big move. So let's put a 10-year chart on, and let me do a weekly. So, for example, once we move back to this area right in here, which will be a pivot off of this fourth wave low. So this blue box, yellow box, somewhere around this area, 1700. I think it's going to be a pretty good trading opportunity. I mean, where you could get, a 30, 40, 50% return, back to the underside of this channel before it rolled back over and went down. So there's going to be times to go long. It's just you need to really look at these support areas, these pivot areas, and then have some sort of methodology for entering your trade where you'll be wrong. And we'll talk more about that when that time comes. But I don't want you to think that you're just going to stay out of the market for 10 years. I mean, that's not what I'm promoting here. So don't worry about that. Okay. All right. Let's switch over to toss charts and let's first look at the euro first. I've got some sort of study on here. Oh, there it goes. It went away. Okay, good. Here's the euro. We got a weekly chart up, and the euro is trying to bottom just like the dollar is trying to top. And we've got a situation here. It's just like the one I just talked about. So let's just go through it again, because the more times you see this, the better. So we've got some sort of initial move up, although very choppy. We got some sort of initial move up. So we got a low here, okay, an important low. It's lower than this low. It's lower than that low. I mean, it goes way back. And also there's a trend line here. So we got a low. We got a new high. And then we have right here, we have a higher low. I think I wrote lower low on the other one, which was just a mistake. And then we've got a close. See that? A close above this higher low's high. You can see I was kind of trying to time it in there because I got some like a little gray box when you really zoom in. But this right here, this is a buy signal. This is a buy signal right here. Buy signal right there. Okay. So where's it likely to go? Well, it's likely to go up here where I've got this yellow box. Okay, this is doing the same thing over and over again. Are you always going to be right? No, of course not. Nobody's ever right 100% of the time. Not George Soros, not Jim Rogers, not anybody on Jim Cramer or Fast Money. None of these people are right all the time. What they do is they control the risk. So they know where they're going to be wrong. So where we're going to be wrong on this would be right in here. So you can figure up, okay, well, if I entered here and I'm wrong here, that's, 200 pips or whatever it is. That tells me I can trade, I'm just making numbers up here, but that tells me I can trade, 30,000 mini contracts or something, or 30 mini contracts. Not 30,000, it's 30 mini contracts. And if the in this case the euro US dollar goes to my target, I'll make $2,500, and if it goes down here, I'll lose $350 or something like that. So that's the way you really want to work these markets. You don't want to go, well, I've got a feeling that this is going to happen or that's going to happen. Now, in a 401k, you have to work off a larger time scale, because you cannot be making decisions intraday or even intra-week really in your 401k. So that's why we use this weekly chart. So I'm not showing you things that you have to do on a daily basis. Now, you can zoom in on a day or even an hourly chart to kind of time your entry a little bit better, but you want to make your decisions based on like a weekly chart or something if you're trading or in and out of your 401k. Okay, I think I've made that clear before, but I just want to reiterate it there. All right, let's look at oil. Oil had a pretty steep move a few months ago, and then we've got some sort of rally going. And what we've talked about here is that I was expecting it to move down a little lower into this yellow area, and maybe it still will. I mean, it's possible that oil is in fact in some sort of consolidation triangle, and we're going to move up to this line and then back down into this yellow area. I don't know. I mean, I think what you do if you want to trade oil is you want to try to buy down. What's interesting here is that it's pulled back to a higher low, so it's a higher low here, and but it hasn't really pulled all the way down into this support area. So it depends on how conservative you want to be. I mean, if you want to be aggressive, you could use the higher low, low, higher low, break of the higher low week here and enter oil. But I think you just have to be prepared to change your mind if it starts to roll over and come back, because it's quite possible this rolls over and comes back into this support area. And the reason I don't know, for some reason that's not showing the whole triangle. I don't know how I drew that before. I'll have to figure that out. But the reason I'm expecting a triangle is because triangles happen a lot in fourth waves. And this was such a sharp move that the market needs time to heal or consolidate. So a lot of times it does that in the form of a triangle. Not only that, but this looks like an ABC here. Let's zoom in. So triangles are made up of usually ABCs. They can be made up of different combinations of ABCs, but they're usually ABCs. And you can see here that, well, I zoomed in too much. Let me zoom out. Let me just zoom in with this. So you can kind of see here there's kind of a an A, B, C. So, which would be A, okay, A, and then this would be B, and then C, and then D, and then E, and then it would resolve itself to the downside somewhere down below here, okay, before it takes off back to the upside. So, again, one of the useful things about Elliott is you have some sort of context for what this might be. There's a rule called alternation. So if you just look at this, if you look at this right here, where this kind of went up, and then you've got this, I don't know, kind of sideways consolidate. It can be a flat here where it went A, B, excuse me, down in 1, A, B, C. Okay, so that's a flat. And then usually you have this alternation rule where you have a complex formation followed by a simple formation. And a complex, simple, there's a rule of alternation between 2 and 4. But even then, triangles are very, very, very common in wave 4s, and so this gives you some sort of context for what this might be, and that's why it's one of the reasons I like using the model. All right, enough about oil. It's great for consumers because it's relatively cheap right now. There will be a time when oil gets real expensive, when the dollar really craters, but we're not there yet. All right, so let's look at, what do we want to look at? Let's look at gold. Gold has taken off, and it looks like a breakout of some sort of triangle. Again, these are difficult patterns to really, tell what's going on. But it's possible that gold makes its way all the way to 1450. It's possible there's some sort of smaller triangle here, which it may pull back first and then go to 1450. I think if you want to buy gold, we talked about it, buying it. Now, all along in here, I was talking about buying it. Here, I was talking about buying it. And when I talk about buying gold, I'm really talking about buying physical gold. You can always trade gold. You can look at the GLD. GLD is an exchange traded fund that tracks gold. You can see it looks very similar. You can trade a group of stocks that GDX is a group of gold miners, and a lot of times the stocks will move a lot faster than gold itself. So you can use gold to find a low, like right in, let's say you can correspond a low right in here, and then trade the GDX or the GDXJ, which is the junior gold miners. Again, it doesn't look like it here, but those tend to move faster. They move farther when they're going down, but they also move farther when they're going up. Okay. All right. Silver is lagging a little bit, but again, silver a lot of times will move faster than gold. Like if you do the math on this move here from 15.5 to 22, that's more than the gold move would be from 1200 to 1450. It's a higher percentage move. So if you want to capture the biggest moves, you can trade silver, and that ETF is SLV. It looks like silver, so you can trade the silver ETF. Now I don't know. To me, I don't like trading options with these because they don't. You get kind of chopped up, as you can see here. You get kind of chopped up with the time value. You can sell options, or just buy the stock. Just buy 1,000 shares and spend $15,000, and if you have that, and trade it up to 20.6 or so. So I would stay away from options on these. I don't know. I haven't had great results with the options on things like SLV and GLD and stuff like that. Okay. You could be an option seller if you know how to do that. We can talk about that sometime. But I wouldn't be an option buyer. I wouldn't trade directionally with options on those. I just don't like it. It doesn't seem to perform well. All right. That's about it on that. I want to switch over because I've got a long-term chart, a monthly chart of the Dow, the DIA, which is an ETF that tracks the Dow Industrial Average. And what you can see here, now the software, it didn't pick up the fact that this is a running flat, but really 1 is here, and then A, B, C, 2 is here. So it put 1 in the wrong place, but the result is the same. We've had 5 waves. We've got 1, 2, 3, 4, 5. Where the last the fifth made up of a 1, 2, 3, 4, 5. So very, very common. You can break down any of these impulsive waves into smaller impulsive waves. And what you can see here is, we got outside. It's harder to see here on this, but this particular oscillator is called the trend indicator for MT predictor. And so it was showing a lot of strength. The band is right here. The band, here, let me zoom in, because this may not be obvious. I'm not used to looking at this. The bands for this oscillator are right here. Okay, those are the bands. But then here it crossed outside the band and was trading above the band. So the market got really oversold, lifted the band up, and still outside of the band, but probably am I saying that right? Maybe that other one's the band. I don't know. It's hard to tell with this drawing, but the more important thing is you got 5 waves, and so where's the market likely to go after 5 waves? It's likely to at least go to the 4th wave low. And again, we've had a counter trend rally, and the 4th wave low is immediately upon us with a wave 3 in here in the middle. So, look, it's your money, you do what you want, but if this rolls over and starts going south, it's going to go in a hurry, and you're going to lose a lot of money, 30-40% of your account value. Now, you can ride it out and hope that it stops here and rallies and then get out, but I'm just telling you, sleep a lot better if you accept the fact that we've had 5 waves, and maybe you don't understand what that's all about, but you know enough to know that every time I see 5 waves, it goes back to the 4th wave low. And maybe I ought to just compile a bunch of moves like this. I can't compile a bunch of moves like this because this is on a monthly chart, but I could compile a bunch of shorter term moves that have 5 waves, and you can see how they go back to the 4th wave over and over and over and over again. Okay. The difference is here, this one is a very large pattern that spans from 2009 to the end of 2018, so 9 years. And it's hard to go find a bunch of those because there's only so many. But and maybe there's none other, because they said this was the longest bull market in history. So maybe there's no other 5 wave moves like this. So anyway, that is it for this week, guys. Thanks for coming in. Thanks for listening. Share the show. It's going to be important. I mean, your relatives are going to start talking about this. They're going to start talking about how you're losing money, and you're probably going to be tempted to say, well, I haven't lost anything because I've been kind of following this guy Seth on the Middle Class Investor, and he's been he kind of warned all through here, and maybe I lost the opportunity to make some money, but he's kept me out of this huge sell-off, and it's just better to at least give them the opportunity to say, no, you can't time the market. And you'll hear all kinds of stuff. You can't time the market, and blah blah blah. And that's sort of true, but there are it's loosely true, let's say it like that. But there are millions and millions of traders that exploit inefficiencies of the market. It's not impossible to do, and so you just need to know that it is possible, and forget about what other people are doing. If you want to be successful, figure out what everybody's doing and do the opposite. That's what I've always heard, and that seems to work. So, all right, everybody, thanks for coming in. We'll see you next week. Bye bye.